In today's video, we're learning about the path to acquiring mortgage notes, both performing and non-performing. And the acquisition process starts with finding and vetting the loan seller. Now, this is such a critical step because if you don't have a pipeline full of deals to buy, well, you're not going to be able to invest in mortgage notes. So because this is such an important topic, we've got another video coming out later this month, so get subscribed, called How to Find Great Deals in Unlikely Places. This is looking at the diamonds in the rough so that you can get off-market assets for the best possible prices. So the next step is your pre-bid waterfall process. Before you make your indicative offer, you want to make sure that the high-level facts about the asset line up with your investment criteria. So here's that due diligence waterfall, and if you go to my website and sign up for our course, we'll send you an interactive version of this document that links to different videos on this YouTube channel to explain every step of the way. Next, we have the submission of your letter of intent. The letter of intent, or LOI, is how you make an offer on a mortgage note to the seller. And this letter of intent includes some contingencies and terms, the timeline, and most importantly, the exclusivity with regard to your complete due diligence. Before you're spending money on broker price opinions, BPOs, or title reports and buying credit reports to analyze the borrower, you want to make sure that the seller understands that you have an exclusive right to purchase this loan within the timelines desired. Next is your complete full due diligence. Now that you're exclusive on the offer, you need to make sure that you do all of your research following every step of that due diligence waterfall. Then you're going to finalize your offer. Once you've completed your due diligence, basically ensuring that all of the information that was provided by the seller is accurate and there was no misrepresentations, you can move forward with the price that you offered. Now, if you find some things out on the loan that don't match what the seller told you in the first place, well, in that case, you can start to renegotiate pricing. Next step in the process is to review the contract. The LPSA, or Loan Purchase Sale Agreement, is the contract that you'll be acquiring the loan through. The most important thing to look at on the LPSA is the representations and warranties of the seller. In this section, you'll see if there's a repurchase guidelines, whether if there's an issue with the loan, if you can get a refund and send the asset back, or if you have any at all representations around the enforceability and the completion of all of the collateral documents. Once you've got all that out of the way, you've signed the contract and sent it back, you want to fund the trade. Now, this could be sending a wire directly to the seller, or if it's a seller you've never worked with before, you might want to work with an escrow third party in between you and the seller to make sure that the funds and all the documents on the loan are properly exchanged and everybody's happy with the end result. Next is to coordinate the servicing transfer. Having a licensed loan servicer on your team, someone like Land Home Financial Services, Madison Management, Allied Servicing Corporation, FCI Lender Services, the list goes on, but having one of these licensed servicers to board your loan with is super important in the next step. Now you're going to be reviewing the actual physical collateral files. These documents are going to come to you in the mail or be sent to your collateral custodian if you outsource this process. But essentially, you're going to be making sure that you have the note, the mortgage, the assignment chain, and the allonge chain. You're going to want to make sure to record your assignment of mortgage so now that your entity is in the public record in the local properties county. So everybody can see that you now own that mortgage note. And finally, you can begin your management and collection process on the asset, working with attorneys, realtors sometimes, your loan servicer, to turn a non-performing loan into a performing loan, or maybe a loan payoff, or to keep that performing loan making payments to make sure that you receive that monthly cash flow. And that wraps up today's video on the acquisition path to acquiring non-performing and performing loans. Definitely check out our website for how to invest in mortgage notes, the free course to let you know everything to get to the next step in the process.